Hello, welcome back. This is Si Wing Yi. So let's go over what's going on in this market, which is very interesting. So let me just go ahead and share my first screen. So as you may or may not know, the mortgage rate has drastically came down uh, to a point where it's minus 60 basis point from earlier this week to now. It was before like 7.3. Now it's approximately 6.62% on the 30-year fixed rate, according to Mortgage News Daily. So that is a very, very good sign. And furthermore, this article that was provided by Yahoo's Diana Olick, and the headline several days ago, mortgage rates fall sharply to under 7% after inflation eases. So we are seeing a slight inflation reduction. Of course, inflation, the lower the inflation goes, the mortgage rate will follow. That seems to be the trend. So let's go over the key points on this article. The key points are: mortgage rates fell sharply Thursday after a government report showed that inflation had cooled in October. The average rate on the 30-year fixed rate plunges 60 basis points from 7.22 to 6.62, according to the Mortgage News Daily. And the rate, however, is still more than double what it was at the start of this year, 2022. And the article further states that the mortgage rate has fell sharply because of the inflation has cooled and just validated everything. Then down here, the consumer price index rose in October at a slower pace than expected. So that's a good sign. And as a result, as a bond yield dropped sharply and mortgage rates follow, as they follow loosely the yield on a 10-year treasury. Again, the rates are different. There are consumer rates and there are mortgage rates. Mortgage rates follow loosely the yield on the 10-year treasury. Right? It's just so what happens next? And what happens next is this is the best argument to date that rates are done rising, but confirmation requires next month's CPI to tell the same story, said Matthew Graham, Chief Operating Officer of Mortgage News Daily. So he further says that this was always about needing two consecutive reports of this nature, combined with acknowledgement from the Fed that the inflation narrative is shifting. And he said, Graham said rates are not out of the woods yet. They are also likely to move dramatically lower. They're also unlikely to move dramatically lower, as there is still plenty of economic uncertainty, both in US and global financial market. So my takeaway from this rates drop is, don't get out of proportion. The rates are still fluctuating. So requires several more reports by the CPI, Consumer Price Index, several consecutive reports in the next few months to determine whether if inflation continue to ease up, then the mortgage rates may follow. So does that mean that the mortgage rate is not going to go higher than 7%, maybe go to 8%? Well, some people predict the mortgage rate may go up to 8%, but I kind of doubt it. So that would be to me, it would be catastrophic for the mortgage rate to go beyond 7%, and that would really paralyze the entire housing market. So so it's a little bit of good sign, but again, so some people, as a matter of fact, based on a mortgage interest rate of 6.62%, some primary home buyers may still want to pull the trigger if they feel confident that the rate the way they are. So it's a bit of a good sign. So remains to be seen as we concluding this year. It's important to The first quarter of 2023, I'm sure you guys all agree, is very, very interesting. There's be a lot of crucial information is going to happen the first quarter and second quarter 2023 because everything is a lagging indicator. Uh, and so we're going to see some very, very interesting situations moving forward. So yeah, so it's a matter of continuing to monitor the mortgage news daily because they have a lot of updates about the treasury yields, how that how they're trending upward and downward, and that's gonna affect the mortgage rate, and also the consumer price index are also mentioned on a real-time basis on this particular website, Mortgage News Daily. So I will monitor this continually, and we'll give you some real-time housing update, like we have been for on a weekly basis, actually. So with that in mind, let's segue to Redfin report, Redfin news, and the most current article on Redfin. The title was just published on just yesterday, November the 10th, Thursday. So yesterday's Thursday. No, actually, yesterday's Thursday was November the 10th. Today Saturday, November 12th, as I'm recording this. So the title is Housing Market Update. Annual home price growth slows to 3%. Okay, we can take it from a optimistic point of view that year over year, the nationwide 400 metros, still the housing prices have gone up. So technically speaking, year over year, housing prices from 2021 to 2022 have not declined really. It's have slowed. It has grown to 3%. So I'll take it positively with a grain of salt. Although in some cyclical markets, mainly in the West Coast area, we have seen pretty dramatic housing drops, like 7 to 10%, especially in California. So we'll discuss more about that briefly. So let's highlight the pertinent article on this Redfin. Again, home prices has rose 6.2% year over year, the week ending November the 6th. The median home sales price has fallen 8.4% since reaching an all-time high in June. So between June and now, which is November, we have seen pretty, fair housing price declines in some markets in the U.S., and we will go over that momentarily. So, let me see what else. Home buyer demand index, which is a measure of requests for home tours and other home buying services from Redfin agents, has increased 2.8% in the week ending November 6th. And this morning's report a few days ago is that the overall inflation rate is finally starting to back off. Makes it even more likely that the Fed will slow their rate increase to 50 basis points next month in December, according to Redfin Deputy Chief Economist Taylor Marr. And however, the Federal Reserve Chairman Jerome Powell has indicated that inflation would need to slow for several consecutive months before the Fed would lower its target for how high, if raising rates for next year, 2023. Okay? So the buyers who remain in this market are likely getting much better deals than the median asking or sales price reflects. The typical home now sells for less than asking price, drops remain at a record high, and seller concessions are becoming increasingly common. So what this means is the buyer's market is kind of creeping up. The buyers have more negotiation power, they have more leverage, and there's more incentive from the seller. So for those buyers that even with the close to 7% mortgage rate, if you can afford to buy a home wherever market you are, then you might want to pull the trigger as long as you have this long time buy and hold strategy of 5 to 10 years, then you should be okay. You can overcome any down real estate cycle as is happening right now. So, but then again, at 7% interest rate, mortgage rate is putting a lot of potential primary homeowners, the buyers, still on the sideline. So people are waiting on the sideline. That's my main takeaway. So there's a lot of confusion going on in the market, a lot of volatility. People simply are, for the lack of a better term, they are scared. All right, so they are scared. So let's get back to the reference report. So leading indicators of home buyers activity. So the seasonally adjusted Redfin buyer demand index is down 34% year over year during the 4 weeks ending November 6th. Touring activities as of November 6th was down 30% from the start of the year. And so that's what's happening. So key housing market takeaways for 400 plus US metro areas. So here are some of the highlights. Again, as we discussed, the median home price was $359,250, 250, up 3% year over year. The slowest sales price growth since the beginning of the pandemic. Understandable. The second paragraph, once again, the home sale prices has fell from a year earlier in 6 metro areas, which is in San Francisco, where I live for the past 32 years in San Francisco Bay Area, and San Jose in the East Bay. The entire Bay Area has the home prices that decreased anywhere from 7 to 10%, depending on the neighborhood. So yeah, it's been kind of falling off the cliff, if you will. Again, California housing market is always in, it's like what I call it a cyclical real estate market. It's go up and going down, but when it goes up, it goes really up in terms of appreciation over the past few decades. Trust me, I experienced that myself with my properties here in California. And so Stockton is also in the Central Valley in Northern California, has some price declines. Oakland, which is in the Bay Area, San Jose, and what have you. So the next paragraph, pending sales fell in a lot of those trophy markets, like pandemic boom towns like Las Vegas, Miami, Seattle, Portland, Phoenix, Riverside, and Atlanta. So these are pandemic boom towns. They have seen drastic reduction of pending sales. So the inventory is drying off, and so they can have a very low supply of inventory in this pandemic boom to bust markets. All right, let me see what else. The next takeaway is, like I said, pending home sales is down 34% year over year, the largest decline since 2015. So when you see pending home sales decline this much, this means if this trend continues, we could have a low supply of inventory for the future. So let's watch the interest rate. So, okay, I'll give you my takeaway later as we conclude this presentation. New listings of home, see everything's down. I mean, we have a crash in transactions. If you know what I mean, not necessarily home prices, a crash in transactions, a crash in new listings, a crash in demand for purchasing. So it's very interesting dynamics. We'll go over that. Okay, the next takeaway from this paragraph for me highlighting was the month of supply of inventory. Supply of inventory is 3.3 months. Just to reiterate, a balanced market is anywhere from 5 to 6 months supply of inventory, where so right now at 3.3% is still a very low supply of inventory. It's still a seller's market nationwide, we're talking. All right, so keep that in mind. Remember during the bidding offer during the peak of the pandemic boom, like 2021, 2020, the supply of inventory of home is like 1 month inventory, 1.5 month inventory in various markets. So what now inventory's supply is higher, up to 3.3%, but still from a historical perspective, it is still a extremely low supply of inventory. So when you have low supply of inventory, and if in the future we have a high demand, which is could very well happen, then you may have some buying frenzy, as I call it. Quote, this is my quote: buying frenzy could occur sooner than later, especially if the mortgage rate can decrease to 5 to 5.5%, as some housing experts predict. All right, I'm getting ahead of myself a little bit. So also the homes that sold were on the market for a minimum of 35 days, up more than a week and 27 days a year earlier. But again, we're just comparing the last few years. This kind of comparison is sort of a very limited sample size, if you will. But if you compare from a historical perspective, no, homes selling for 35 days is pretty normal pre-pandemic times, especially. Does that make sense? So on average, a record 7.9% of homes for sale each week had a price drop, up from 3.6% a year earlier. Yes, that's happening in a lot of markets, a lot of price drops. Sellers are not getting the memo. All right, and then the average sale to list price ratio, which measures how close homes are selling to their final asking price, fell 98.7% from 100.4% a year earlier. This means this is lower since the beginning of the pandemic in July 2020. This means almost 2% of the homes that are sold have the seller dropped 2% from their final asking price. So as we're almost concluding this presentation, let's go over the graph real quickly to kind of recap and summarize what I discussed from this Redfin report. Median price up 3.2% year over year in all 400 metros. I want to mention, reiterate that local, real estate is local. Every market is different, but this is just the average of the 400 metros that are tracked by Redfin. Some markets have been appreciating quite consistently, single digit or even double digit. You'd be surprised. But the media always talk about the trophy markets, like in a western region of the U.S. and a few other hot spots in other part of the country. But until you look at the local real estate market, you never know. So do your research, do your due diligence. Okay. Second of all, median asking price is up 6.5% year over year. What they're asking, what they're getting is different, right? And home buyers' mortgage payments has skyrocketed to 50% year over year, because when you had a 3.5% mortgage rate early this year, now average 7%. Obviously, if a home buyer would buy a new home, the mortgage payment will be much higher at around 50%, as indicated on this graph. Therefore, a lot of people cannot afford to pay 50% higher monthly mortgage on a similar price home early this year or late last year. So that's why a lot of people are staying in the sidelines because of skyrocketing home prices during the pandemic, and the mortgage rate has risen to around 7% from its historical low of 2.53% a year to 2 years ago. All right, pending sales is down 34% year over year, so we have less and less sales. Part of the reason is the seasonality. The last fourth quarter of every year, we have always, historically speaking, have less sales, because this is when people does not want to move. People, there's the holidays coming around, so home purchasing and home selling are not necessarily on top of their mind in terms of life priorities. Also, some people still buy and sell even during this last quarter of any given year. So new listings is down minus 17% year over year. Of course, people are not listing their homes. The home sellers are many homeowners right now. They have massive amount of equity. They have locked in at an extremely low historical rate, so they have very little incentive or motivation to sell their homes until and if the interest rate comes down. They may in the foreseeable future, may want to sell. But active listings up 10% year over year, but it doesn't matter. We have more listings, but if the demand has subsided as a result of the interest rate, you're not going to get the buyers going to buy those inventory of homes. So again, 3.3 months of supply is still a seller's market. Some people don't like that. Some of you think, oh, we are the buyer's market now. The tide has turned. Not so quite. Still a seller's market at 3.3% months of supply of inventory. And because the equilibrium is 5 to 6 months, right? Supply and demand. So economics 101, when supply is lower than demand, houses will continue to increase. So 34% of pending sales were under contract within 2 weeks. So we still, you still have some quick sales. You still have some multiple offers. No, not multiple, 2 or 3 offers per house in some local markets in some part of the country. Not everything is bad. So yeah, so 1/4 of the pending sales are under contract within 1 week. So people still, some demands out there. People still can afford a mortgage payment, even though at 7%. So right, and home sold at a median 35 days, which is historically speaking pretty typical. And 28% of homes sold above list price. This means 72% of homes are sold below the list price. So good incentive for buyers out there to do well. So it's not all bad. So I think let me see. Average home sold for 98.7% of final list price. This means almost 2% are or so below the final asking price by the seller, right? The demand index has dropped 34% year over year. Home buyers demand, so demand has subsided, and but it's all about the interest rate. It's all about inflation. So let me see. So my final takeaway is, we are seeing a little bit of good news with the mortgage rate coming down a little bit. Let's in next few months, the first quarter next year. So let's see how it is. If the mortgage rate stays at 7%, then demand is going to be bad. So people, home buyers could be on the sideline, and sellers are not going to sell. So it's going to be still a lot of volatility in this market. But so that's a light to me. That's a light at the end of the tunnel. So again, there's some of you that want to buy right now, even at a higher interest rate. You heard the term, you date the interest rate, you marry the house. But that means you have to overcome this correction situation. If you want to buy a home as a primary home to live or as a real estate investor, you buy and hold, because the rate can always adjust, change. You can refinance down the road, whatever. But it's nice to be a homeowner. It's the American dream. So as long as you have a long-term perspective, buy and hold, whether you are a primary homeowner or a real estate investor, we're talking 7 to 10 years down the road. That's the takeaway that you should have. So the housing market is not all doom and gloom. It's not, the sky is not falling. All right, and things will get better. I know. The job market, is quite interesting right now with the high tech layoffs. Just a little bit, some trickling of it, but it's still not doom and gloom. So we'll see. So that's all I have to say. And if you see a lot of value from this video, please smash the like button and also subscribe to my channel, and so you can receive weekly updates about real-time housing data. So you can become an informed primary home buyer, seller, or as a real estate investor. As a real estate investor, if you want to be one, or you already one, perhaps you could at the bottom of this video on my website, you could enter your email to subscribe to our free newsletter. If you do so on a weekly basis, you're going to get a lot of great real real estate investment news, education about real estate investing. So be part of our real estate investing community with our network. All right, thank you so much. This is Steven Yi. I will see you shortly on the next video. Have a nice day. Bye-bye.